If you're a UK business owner looking for reliable finance options, peace of mind and the best loan rates, then you're in the right place. By the end of this video, you'll know exactly what type of business finance is available, how it works, and which one might suit your goals, whether it's managing cash flow, funding growth, or getting through a rough patch. Not all finance is equal, and it's important to apply for the right loan for your business's specific needs. Now, if you're watching this, chances are you've hit a wall trying to find the right finance. Maybe your bank said no. Maybe the options you've seen are confusing, or you just don't know what's best for your business. We've seen it all before. Businesses rejected by one lender and then approved by another within 48 hours. It's not about your business being bad, it's about finding the right fit. So if you want a good business loan with good terms that suits your business and peace of mind so you're not second guessing if you're getting a good deal, then listen up. Let's walk through the main finance options out there. No fluff, no jargon, just what you need to know so that you can make an informed decision. First up is an unsecured business loan. These don't require any collateral, so you're not putting your van, your shop, or your tools on the line, which can be a relief if you don't want to risk your assets. You borrow a fixed amount, repay it over an agreed term, and you can use the funds for just about anything: stock, wages, marketing, or simply keeping the lights on. It's a fast and reliable option, especially if your business has steady turnover and a solid track record, but it's not without downsides because there's no security involved. Interest rates can be higher compared to secured loans. Lenders often base approval on your credit profile and trading history, so if either is a bit patchy, it might be harder to qualify, or you may be offered less favourable terms. Also, repayment terms tend to be shorter, which can mean higher monthly payments. So while it offers speed and flexibility, it's important to check the cost and make sure your cash flow can comfortably handle the repayments. Then there are secured business loans. These involve offering an asset such as property, vehicles, or valuable equipment as security against the borrowing. Because the lender has something to fall back on if things go wrong, they're generally more willing to lend larger amounts at lower interest rates over longer repayment terms. That makes secured loans particularly useful for significant investments like expanding to a second location, refurbishing your premises, or purchasing large-scale machinery or vehicles. If your business has valuable assets and a clear plan for growth, this type of finance can provide the capital you need without the high costs that often come with unsecured borrowing. But there are risks. The most obvious is that if you can't meet the repayment terms, the lender has the right to seize the asset which you used as security. So it's essential that the loan is taken out for a strong business case and not just to plug a short-term gap. The application process can also take longer and involve more paperwork than an unsecured loan. So while secured loans offer attractive terms and flexibility for the right business, they require careful planning and a realistic repayment strategy to ensure you're not putting your business at unnecessary risk. Next, we've got asset finance, which is a form of secured finance, which can be a smart option if you need to upgrade equipment, like vans, tools, or machinery, without shelling out a large lump sum up front. The finance is secured against the asset itself, meaning lenders are often more willing to approve applications quickly, even if you've struggled to get unsecured finance. You get to use the equipment from day one while spreading the cost through fixed monthly payments, which helps protect your cash flow and preserve working capital for other areas of the business. That said, there are a few things to consider. Because the asset acts as security, you don't fully own it until the finance is paid off. And if you fall behind on repayments, the lender could repossess it. You'll also need to ensure that the equipment you're financing retains enough value, as depreciation can affect your borrowing options down the line. Asset finance tends to suit businesses in trades, construction, logistics, or manufacturing, sectors where having the right tools and vehicles is essential for day-to-day operations and growth, but where tying up large amounts of cash up front isn't practical. If your clients take time paying, invoice finance can be a real lifesaver. It allows you to unlock the money tied up in unpaid invoices. So rather than waiting 30, 60, or even 90 days, you can access the majority of the invoice value within 24 hours. This can dramatically improve cash flow and helps you to manage day-to-day expenses like wages, materials, and overheads without needing to chase late payments. It's especially useful for businesses in contracting, wholesale, manufacturing, or any sector where long payment terms are the norm and large commercial clients are standard. However, it's not without drawbacks. Invoice finance involves fees which can eat into your margins, especially if your invoices are small or frequent. Still, for businesses with reliable invoicing and strong sales on credit terms, invoice finance can be a powerful tool to smooth out cash flow and reduce the pressure of long payment cycles. For businesses who accept card payments like shops, cafes, salons, and hospitality venues, a merchant cash advance can be a flexible way to access funding. You borrow a lump sum based on your average card sales and repay it through a fixed percentage of future card takings. That means when business is booming, you pay more back, and when things slow down, your repayments automatically adjust to match. It's a popular option for businesses with seasonal or fluctuating income because it moves with your cash flow rather than putting pressure on it. That said, flexibility comes at a cost. Merchant cash advances can be more expensive than traditional loans, with the total repayment amount often fixed up front and calculated using a factor rate rather than a standard interest rate. This can make it harder to compare with other types of finance. Also, because repayments come off your daily or weekly sales, it can reduce your cash on hand, which might create pressure during quieter periods. It's best suited to businesses with steady card turnover who need funding quickly and prefer repayments that match their income patterns without the rigidity of set monthly payments. So, what's right for you? That depends on how much you need, how soon you need it, and what it's for, your trading history, and how comfortable you are with risk. There's no one size fits all, but knowing your option means you're less likely to make costly mistakes, like jumping on the wrong loan or borrowing more than you need. A common mistake, going to your bank first, getting declined, and thinking that's the end of the road. Banks reject thousands of perfectly good businesses every year, not because you're not viable, but because you don't tick every box. That's why it's worth speaking to a broker or independent lender who understands your sector and your situation. And if you've been turned down before, don't worry. We've worked with builders, retailers, cafe owners, accountants, and more who were declined elsewhere but got approved quickly through a better suited lender. So we know that no doesn't mean no forever. It just means you need a different approach. When you're ready to apply, you'll generally need just a few things. Your business bank statements, around 3 to 6 months, your most recent accounts, some ID, and a brief overview of your business and what the funding's for. And here's a key tip. Don't leave it too late. Plan ahead. If your bank balance has been steadily falling, lenders can spot it. Apply when your business is in a position of strength, not desperation. We've helped countless business owners secure the right funding at the right time with less stress, better rates, and a clear path forward, like the cafe owner in Manchester who got invoice finance within 2 days after a high street bank declined her, or the electrician in Kent who used asset finance to buy new equipment and boost his monthly turnover by 40%. I hope this gave you a clearer picture of what's out there and how to approach business finance with confidence and clarity. If you found this helpful, subscribe for more straightforward, no-nonsense advice tailored for UK business owners like you.